Hey guys, Max here, and yesterday really was insane for the markets. They boomed, in short, on news that the US economy shrank last quarter. Yeah, you heard that correctly. GDP fell, but stocks rose. It seems pretty ridiculous, and to be honest it is. There are some small bits of logic there, and I will explain all of that, explain what investors were looking at and what they were ignoring. So let's just get right into it. Now, stocks were up, as I said. The S&P 500 rose by 2.5%, and the Nasdaq did even better and rose by 3.1%. It was, by all intents and purposes, a huge rally for the day. As you can see, green everywhere. Tech led the charge though. FANG followed as well, up 3, 4 or 5%. Some companies like Nvidia were even up by 7% yesterday alone, so a super strong rally. Other industries did pretty well too, just not quite as well as tech. European markets were just a little bit more reserved. The Stoxx 600 was up by 0.6% and the FTSE 100 was up by 0.7%. Still green, just not super bullish or anything like that. For US equities though, that was the best single day of trading in about 2 months, so it was very welcome to most eyes. There was lots of red prior to this, as I'm sure you know. Now the dollar rose again. It continued to see strength, and it's now up another 2% against the yen and about 0.5% against the euro and the pound each, showing just no sign of slowing. There's just so much more security in the dollar right now, even with recession fears at all-time highs. Now, bond yields didn't move too much either. The US 10-year Treasury yield is still sat at 2.84%. There were no real inflows or outflows for the day. Again, that's a very high figure though. 3 months ago, yields at almost 3% would have seemed absolutely insane. Now, oil prices actually rose 3%. They rose again, and that explains the strong energy sector performance for the day. WTI crude oil is sitting at about $105 a barrel right now, and Brent crude is at about 109. Oil prices could be moving back up toward the $110 or even $120 mark. There are no supply side shocks to actually cause this rise this time around though. In fact, there have been some demand hits that should have kept oil prices low, like Chinese lockdowns, but so far, oil prices are just staying really high. Gold finally actually fell below the $1,900 an ounce mark. Right now it's sitting at about $1,896. That's nice to see in my opinion. I'm going to be buying back into gold consistently again. I had held off since the invasion of Ukraine really kicked off, as gold spiked up to that $2,000 mark at times. Now finally, how did crypto do? Well, it didn't do very well. It fell for the most part, but not by any insane amount. Bitcoin was down below $39,000. Ethereum was down below $2,900. Both were down about 2% for the day. Altcoins did slightly worse, falling 4 or 5% for the most part, and this was all just a little bit unexpected. Tech stocks soared, so we should have expected crypto to soar as well, but if tech soared on earnings news, on these companies actually performing well, as opposed to, say, news about the Federal Reserve's interest rates, well, that's not too relevant for crypto markets, so maybe that's why they moved independently of each other. What was the focus for the day then? Well, as I said earlier, there were two big ones. The first was the US GDP figures that came out, and the second was just some more corporate earnings. GDP, in my opinion, was the most important one yesterday. It was also a little bit more of a one-off. We don't get figures for the GDP too much, so we'll start there. So US GDP, gross domestic product, or basically just a measure of the American economy, last quarter it fell by 1.4% at an annualized rate and 0.4% for the quarter on its own. This is down from an estimated growth level of about positive 1% and sometimes even higher, so that was a huge total shock to the system and to loads of investors. Tons of people though, and especially analysts, are just kind of ignoring this news and pretending it doesn't exist. The big talking point throughout this is that the decline in GDP was as a result of businesses building up inventories in the past, so not buying new stock last quarter because they'd already filled up this time, so it wasn't a real decline. The problem with this idea of thinking though is that even if this inventory build-up didn't happen and that didn't contribute to the fall in GDP at all, we still would have seen GDP fall at an annualized rate of 0.4%. This also ignores the fact that from February to March, real retail sales actually fell by 0.7%. So this idea that consumer spending is still really strong, which is the narrative going around on Bloomberg and places like that, doesn't really hold true in my opinion. Now, why else was GDP growth negative? Well, government spending decreased slightly. So again, people are saying that that's the reason GDP fell and that it isn't representative of the economy. But government spending is not natural. It isn't people wanting to buy something and having the cash to buy it, so they buy it. And it's not an indicator for a coming recession. It's simply just loads of bureaucratic decisions pulled together across the entire country. We also saw poor trade balance of payments last quarter for the US. Obviously, imports for the US will decrease GDP, while exports for the US will increase the GDP. And because the rest of the world is suffering as well, especially Europe with all the chaos surrounding Russia and the war in Ukraine, the US balance of trade got worse, so GDP suffered because of this. Again, people are ignoring this news and just saying that it isn't important because it's not the American economy that dictates those changes in imports and exports. But it doesn't matter where that recession stems from. If US exports fall in comparison to imports, then growth will decrease. It is as simple as that. What this all comes down to, really, in my opinion, is people saying if you ignore all of the bad stuff and you take all of the bad stuff out, then the GDP report was actually good. And in my opinion, that is utter lunacy. If Ted Bundy hadn't murdered a bunch of women, he would have been an okay guy. Yeah, okay, fine, but one big problem there, he did murder those women, and one big problem there regarding this GDP figures was that it was negative. If you remember back last year into 2021, we saw the exact same argument being used by the inflation is transitory cultists back then too. They said that if you ignore inflation because of used cars or because of food or energy, then it's really not so bad. But in the end, they were all proven wrong, and in my opinion, they will be proven wrong here again. All I say is stop cherry picking data, look at all of it in aggregate, and this GDP figure that we got, the negative one, came in aggregate. It looks at everything equally, it doesn't cherry pick the good or the bad. Now, of course, the traditional or the mainstream definition of a recession is 2 consecutive quarters of negative growth. I know that, everyone knows that, it's really nothing groundbreaking, but that's really just what you read in economic textbooks. In the real world, a recession is just a period where the productive capacity of a country declines. It's where growth stalls and goes negative. It's where people get poorer. Now, that decline in the US has already started. It may skip a quarter or so until it continues in the future, but in reality, the decline is here, and long term, I think it will stay, probably for about a year or maybe even longer. I really do think the recession has already started, and that it actually started probably a couple of months ago. We only just got the data to prove it. Now, markets and investors, as always, were happy to just ignore the bad news. They want to see the best in the economy so they can continue to make money. So that's really what they're doing right now. The fact that stocks grew on this news is absolutely insane, in my opinion. But the argument against me here is that stocks didn't grow on this news, they just ignored it and they were paying attention to corporate earnings. And of course, earning report have been quite a big topic for this entire week so far. We had Facebook's earnings the day before last, which was good enough. It wasn't actually a beat. It was actually a miss on revenues, but expectations were so low that the markets treated it like a beat. And so maybe that was part of the trigger for the tech stock rally. Again, it's really hard to say what caused that rally, but in general, sentiment was just high because most companies are posting good earnings. Now, what other earnings did we see yesterday? Well, McDonald's came out and their earnings were quite strong. They rose almost 3%. Merck did quite well too, gaining about 5%. We did actually mention yesterday that Tesla was crashing the day before. It fell 12% in a single day, which was a huge dip, and everyone was wondering why, and plenty of people were panicking. Now, the idea was that the risk of Elon being margin called on the new debt that he's taking out to buy Twitter is a little bit scary, and if Tesla's shares dropped in price by about 40%, he would get margin called and have to sell those Tesla shares, so Tesla would then crash even further. So just investors got a bit worried and exited their positions and dropped Tesla's share price in advance. Now, that probably did happen to some extent, but it wasn't the only thing going on. There were lots of people wondering if Elon was selling Tesla shares. Now, no one actually knew at that time. We had hints, but it was all just speculation and rumors. We do now know that that was the case, though. He came out and said it. He sold about $4 billion worth of Tesla stock, probably because he's going to need some cash for this Twitter sale, maybe to lower his debt burden, maybe in case he gets margin called so he has cash on hand. We don't know exactly what the reason is, but we know it's something like that. What this blatantly isn't is Elon losing conviction for Tesla as a company. We can say that for sure. Elon then came out and he said that he will sell no more shares from this day forward, giving some stability to the price. Tesla investors obviously like that. He was actually quite transparent with this sale. He published it with the SEC as soon as he could, so it became public knowledge. He's probably just trying not to destroy any goodwill right now. The Twitter deal does still look like it's going ahead. There's no real news on this front, and there will be a $1 billion forfeiture if either party backs out, so it's looking quite likely right now. Now, if you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that can help you protect your portfolio against inflation through fractional shares of art from world-famous artists like Banksy. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets on the brink. It's completely free to sign up, so make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get over 7% interest on stable coins to protect your hard-earned cash from being eaten away by inflation. Thank you all for watching. Stay stoic. Until next time.